So excited about this opportunity to spend some time chatting with both of you gentlemen today, and certainly to our membership base. And we really can't thank the both of you so much, Angel Oak and also UWM for your incredible sponsorship as Bee's Knees sponsors. And people wonder, what is a Bee's Knees sponsor? So we often, mention that, each year our annual convention and trade show has a theme to it. So we're kind of taking a little bit of a Great Gatsby theme, and we title our premier title sponsors with something associated with that. And many people don't know this, but a Bee's Knees was a very popular beverage back in that time. So we call it the Bee's Knees title sponsorship. So if anybody's out there and wondering, what is a Bee's Knees sponsor? These two gentlemen are part of that. And we thank you for that. It's our signature title sponsors, and they really keep us kind of moving forward, make our convention, attractive, aggressive. And we're super excited about that, because the Florida convention and trade show that we host here at the Florida Association of Mortgage Professionals is by far one of the top conventions in the country, and has been for many, many years. And we certainly couldn't do it without the incredible sponsorship of both you gentlemen and your organizations and fine organizations. So thank you for that. Are we handing off to Mrs. Linda Knowlton, our immediate past president, to kind of kick us off this morning? And if not, that's quite all right, because I will do it. So, ladies and gentlemen, I just want to thank you so much for participating and attending this morning. My name is Nathaniel Bittman, and I do get truly and a tremendous honor of being able to serve as association president for the state of Florida this year. We here at the Florida Association of Mortgage Professionals are always focused on value to you as our members. It is a labor of love. Our directors and our board members and those of us who serve as committee chairs, we're volunteers, and we put a lot to make sure that the Florida Association of Mortgage Professionals is really your home that you can come to get education, content, career enrichment, and so many other important things like advocacy and so on and so forth. And today we have two of our title sponsors that are going to be speaking today, giving you some important insight about what's happening in the industry. I'm joined by Jean Monod. Did I get that right? I want to get that right. Jean Monod. Jean Monod. Right?
Jean Monod is a real pronunciation. Jean Monod is fine. So you did a great job with that.
Yeah, I don't want to call you Jean Monod because that's just so American. I want to give that French, that swagger to her, Jean Monod, which is so cool. And of course, Eric Mojita from UWM. So thank you both, gentlemen, for joining us today. Just a little background on these gentlemen. Little bio on them. Eric began his career in the mortgage industry in 2000 as a loan officer for Quicken Loans, leaving after 4 years as an executive mortgage banker. After that, he spent a year as a loan officer in the wholesale channel before moving to City Mortgage in retail lending, where he spent 2 years. Eric left the mortgage industry in 2008 to work in pharmaceutical sales. All right. To pharmaceutical sales, which provided world-class sales training and experience working B2B, which we know is such a crucial thing these days. In 2012, he returned to the mortgage industry with United Wholesale Mortgage and advanced to a team leader and also assisted as vice president role for the last 3 years. Since 2019, Eric has been the VP of sales and has helped lead a sales team of over 700 inside account executives as they work to keep UWM the #1 wholesale leader and the #2 overall mortgage lender in the nation, which is an incredible accomplishment. Congratulations to all of you. Eric has 2 children who he spends most of his free time with, and they enjoy tennis and eating out at new restaurants. So thank you, Eric. John is a regional VP of sales for Angel Oak Mortgage Solutions, is an expert in reliable consulting, supporting brokers and correspondents. He has spent over a decade focusing on the non-QM lending space, and he puts in a tremendous amount of time. It's all he knows and loves. And I know you do dedicate a lot, to the industry and non-QM lending. We're going to hear a little bit about that today. John has an impressive, diverse background ranging from retail and commerce to marketing and business development. The majority of his experience has been in wholesale lending. His favorite thing about Angel Oak is the ability to communicate through all channels of the business, from sales to operations to marketing. His hobbies include playing golf, staying fit, and cheering on the New York Yankees. Although the Rays here in Tampa are given quite a bit of a run there. The Rays are looking pretty good. So thank you, gentlemen. We appreciate you joining us today. What we have in this panel discussion is we have a series of questions, and some of them are open-ended. With each one of you are welcome to go ahead and answer those. Some of them might be very, targeted to really kind of your kind of area of strength. So let me begin by question number 1. Given the current environment, what are some of the suggestions that you have for loan officers in developing business. As we know, we're dealing in a rising rate market, a lot of instability. We know that the Fed's going to be telling us today whether they're going to raise by a quarter or not. So we're always diligently watching pricing, and we're seeing that there's a bit of an inventory crisis. What are some developmental strategies that loan officers can follow? And either one of you gentlemen can start. We can certainly start with John if you'd like, and then we can pass it off to Eric.
Yeah, Nathaniel, thank you. And again, thank you to FAMP for putting this on. Really appreciate your partnership. I would just say, get back to the basics. It's really, there's less business out there. And, it's kind of like, go back to that, get comfortable being uncomfortable, get out of your comfort zone, get back to the basics, reevaluate what you've been doing for the last 6 months. And if it's not working, devise a new plan. This is going to be a little self-serving, but, the agency business is down, right? So go look for that non-QM business. You talk about, the self-employed borrower is the fastest growing segment of the workforce out there. So, obviously doing bank statements for self-employed borrowers. So, and I think, just everyone has their referral source. Well, educate your referral source on new borrowers out there and just continue to push that envelope. But I think the biggest thing is, get out of your comfort zone.
Great advice. Thank you, Eric. Any recommendations or suggestions?
Yeah, I love it. I always say something pretty similar. Like if it's been working for you already and it's continuing to work, then stick with it. But then what can you add on to kind of open up your market? There's, there's home affordable products out there, home ready, home possible. And those AMI limits just went up. If you're not familiar with things like that, you need to make sure that you're adding that to your repertoire. Non-QM is another great option, as John mentioned. So just trying to make sure you have every product out there, whether maybe you've been a conventional loan officer mostly, but now you realize, okay, 1 out of 5 clients could be an FHA borrower right now. Maybe traditionally you don't think you can compete in jumbo, but now you realize, listen, there could be an opportunity. So that's one way, is just finding a new market. The other thing is understanding more tools, because as rates go up, do you have all the products available so that you can go market yourself as a one-stop shop, and things like a temporary rate buy down, for example. If you don't know some of these products, it's not necessarily a new product to the market, but if you've not really been familiar with a temporary rate buy down and how that could be a great option for people right now, we kind of say it as, probably rates are going to be dropping in the next few years. So something like a temporary rate buy down to make it more affordable for those first few years as a borrower. Are you making sure you're familiar with those types of things? And then probably the biggest thing to develop your business is making sure you provide the best client experience, because nobody really wants a mortgage, right? They want the home. Are you making it so that their experience getting the mortgage is so memorable that you become kind of like a doctor or dentist, where it's not like, as a consumer, I go to a different mortgage broker every time I need a loan or a refinance. It's no, like my mortgage professional is somebody that I always go back to, and I'll even refer friends and family to, because that experience was so memorable from start to finish. And then, they stay in front of me regularly. So I think those are the best things you can do in this current market.
Yeah, it seems like it's a good time to be able to kind of dig deep in some of your guidelines and make sure that you're familiar with that. A lot of people don't think about that even in the investor environment. FHA, for instance, you offer a 4-unit, transaction where somebody, we talk a lot about house hacking out there. A lot of people don't think about, a multi-unit FHA transaction with limited down payment. It gives that person the ability to live in 1 unit, maybe rent out the other 3. So for affordability purposes, that's one that people should be familiarizing themselves with as well too. And John, on your front, of course, I think you guys have DSCR loans as well too, correct? I mean, those are some great investor strategies, but investors still seem to be pretty rampant here in Florida.
Yeah, they are. One thing Eric said, if your plan's working, great, keep it going. I would encourage everyone on this call, really look at your next week's calendar. And Eric, and Nathaniel, this comes back to what we did a couple months ago with your leadership group, right? Go look at your next week's calendar and see how well planned out that is. Do you time block? Do you really, quartile your day on what you're going to do? I think everyone would be somewhat surprised if you looked at next week's calendar and looked at your plan and really work that plan.
Yeah, we talk about that a lot, really working the plan and digging in deep. Let's move on to the next question. So we talk about kind of finishing out the year strong. A lot of the pundits out there has said that, by the first quarter, going into the second quarter, we would see a significant decline in interest rates. We haven't seen that. So we talk about, how do you finish out Q3 and Q4 strong? So, what are your recommendations? What are you hearing out there at your level in senior leadership? What's the word on the street with regards to rates? There's a lot of miscommunication and confusion out there.
I'll start this one, and as a loan originator for many years, I've realized I'm very bad at predicting rates, right? When I first started, when rates were at 8.25 on my first loan I wrote, and then I were telling every borrower, like, if rates are down to 7, you'll never see this low again. So predicting has been quite impossible, but I do have the benefit of having a lot of smart people around me. And, kind of our general thought is rates will probably be a little flat or higher towards Q3 and Q4, and when I say maybe flatter, it's because, maybe last year around, the third or fourth quarter rates were like 7.375, which maybe was the ceiling. Now we're down the average 30-year fixed rate more like in the mid high sixes. So, we're thinking with things cooling off a little bit with inflation, and the Fed maybe slowing down a little bit of raising, the rates a little bit, kind of a flat type of thing through the rest of the year and maybe even the beginning of next year.
That's a great indicator. Thank you. John, your thoughts?
Yeah, we just need stability. Our non-QM space isn't as rate sensitive. So really, we just focus on stability. And we all know what happened about, 13 months ago with, rates just going up and the 2-year was going up and loans you were locking today were basically underwater tomorrow. So we're really looking for stability. And we've seen a little bit more stability in that 2-year. That's kind of what we kind of focus on with our business. So I think we're just looking for stability. I believe there's going to, like Eric said, every prediction I've made for the last 16 months has probably been incorrect. So, but I think we're going to see stability for the rest of the year. And then, what happens in Q1, Q2 is really is dependent upon what the Fed thinks too. So.
Yeah, we'll see what happens with that. Thoughts. I'm sure the both of you have been in this business for a while, as have I. We've seen kind of this cycle happen a lot. We'll see as we, there's talk about the fact that we've been in a recession since October of last year. The Fed's not recognizing that because they're fighting a war on two fronts, right? Inflation and recession. I think historically we've seen that once we really kind of come out and announce the fact that recognize that we're truly in a recession, hopefully we'll see some quantitative easing, more capital coming into the marketplace and a drive down in rates. But I think I think that both of you would agree. What I'm hearing you say is Q3 and really Q4, let's accept the fact that we're still in a higher rate market and apply some of the strategies that you were talking about before. Thank you. Let's jump. I also want to make sure that the group that's currently on, ladies and gentlemen in the audience, please ask your questions in the chat box. We will address all of those questions at the very end. So if there's something that pops in your mind, even if it's not on these list of questions that we're presenting here today, feel free to ask any questions of these two gentlemen. So let's go to number 3. Do you anticipate wholesalers entering the arena in 2024? We've seen kind of an interesting combination. We've seen some exiting, we've seen some entrances. It's been kind of a really unique. We know that the emerging mortgage broker really depends on options and choices out there that really differentiates them from the mortgage banker or a bank. So, some of the concerns we've heard out there from a membership base is, is this one of those environments that wholesale lenders will be able to be sustained? Will it have the ability to have choice? Operating as an independent entrepreneur, will I have that? So, what are your thoughts about 2024? Do you see many wholesale lenders exiting, maybe more coming in? Some thoughts on that, Eric? We can start with you.
I think you kind of just mentioned it too. I think it's going to be like musical chairs or like a mix. There's definitely going to be people exiting or merging, which we've seen happen and will continue to happen as things, probably stay flat this year. But there's also new lenders coming in. So I definitely think there's going to be people to replace them, whether they're finding niches or just kind of still compete and finding, just relying more on marketing and technology. I'm excited when I go to trade shows like AIM or these other mortgage professional shows from state to state that you'll see new lenders popping up and having boosts out there, getting a foothold in the market. So I think it is exciting that there will be some additional ones coming in. And, we love competition because that's really at the name of the game. That's the whole point of being a broker is I want to have a lot of different options and different tools for different, different people. And that's the beauty of it. So yeah, we welcome them to come in.
Thank you.
I think we've seen a lot, especially in our space. We've seen a lot come in 2023, right? And then we've seen a lot of national lenders add non-QM to their assortment because they've kind of had to pick up the slack for the agency refi business. I think what's going to be interesting was what does happen in 2024, because we mentioned it just on the previous question, was are those national lenders going to stay in that non-QM space once the refi business starts to pick up, right? Are they going to go back to focus on what they've always done, and that's the agency business? So I think it's really going to be really interesting. I think 2023, the rest of that will be, you know, those who have gotten into non-QM. You might see, as Eric mentioned, you might see a few more booths at some trade shows of lenders that you've never seen before. But I think the biggest or the most interesting thing is who's going to stay in it in 2024, meaning that they're going to stick with their non-QM that they decided to roll out in 2023.
Do you see the non-QM space in terms of balance sheet and performance of loans? Any word out there on the street in terms of how balance sheets are looking with regards to the non-QM landscape? I mean, some of the concerns people have, we've seen this happen in 2006, 2007, that, you know, some of the non-QM players are back then taboo term, but subprime type lending, concerns about tapping out of your balance sheet. Any thoughts of that?
Well, I think we saw what happened to a few of the larger non-QM lenders in, I think it was like September, October of last year. And that comes back to how I answered the previous question. As long as there is stability in that rate market, balance sheets will continue to get better. And I believe through Q3 and Q4, only stronger.
And Eric, do you find that, you know, when we look at kind of the GSEs, we kind of look at Fannie and Freddie, we look at kind of FHA, obviously we see a very inflated market in terms of property values. Any commentary that you're hearing kind of on your end that there's some concerns about just the equity in some of these properties, if properties start to regress backwards, and any talk about the GSE sort of paring back? And we hear a lot out there as far as credit tightening. We hear a lot of consolidations of banks. Any thoughts on your end? What are you guys hearing up there at UWM?
You know, they're definitely looking, you know, at the values and what they're doing. I think that some of the things we feel comfortable on are just, you know, tighter credit, you know, the fact that you do need to be more well qualified, you know, the products like the ARMs, you're qualifying them at higher rates. And so even if equity comes down, you know, I think we're not feeling too bad about that in terms of like that specific type of thing with values and overall risk with the GSEs. You know, I think if anything, they're trying to make things more affordable. I know FHA with the mortgage insurance premiums coming down, it seems like they are willing to still kind of loosen up things up a little bit, and just keeping an eye really on, I think maybe foreclosures ticking up a little bit, but nothing like we've seen in the past. You know, credit to, you know, some of the regulations put in, and then the fact that lenders were able to, you know, follow that. And, you know, minus a few exceptions with some of these banks, I think overall, we're very comfortable.
You know, kind of a sidebar question as we're heading into an election year, a lot of talk about affordable housing out there. A lot of concerns about that. We heard, you know, Jamie Dimon come out from JP Morgan and talk a lot about to kind of keep the market going from an affordability standpoint. Affordable housing was really just trying to not do as much credit tightening. But then, you know, you see some of the big buyers of servicing out there really starting to tighten up and saying, hey, we're wanting better quality consumers. Kind of an interesting thing. So it'd be very interesting to see kind of as an election year how that all plays out. So definitely a bipartisan push on both sides. We're finally hearing on the bipartisan end that both houses, so Republicans and Democrats, are all looking at the supply side concerns of housing. So should be a very interesting 2024 from that perspective.
Yeah, I think, Nathaniel, I think what's going to happen on that, and, you know, our performance on our loans are extremely strong. But I think, you know, you saw, I think it was 2 or 3 years ago when the GSEs put those loan level pricing adjustments on second homes and investment properties. I think that's going to be an interesting, because, you know, they were not in, you know, we talk about affordability, you know, I think it's going to be interesting to see what they do when they put those portfolio caps on, whether it's 7% or 3% for second homes, investment properties. So I think that's going to be really interesting. And does that business then go to the private sector, which is not QM space?
Right. Yeah, it should be very interesting. It's definitely one that we kind of want to look at in 2024. We always see historically in an election year, we start to see rates come down, and we talk a lot about affordability. So thank you for that. We'll jump on to question number 4. So do you anticipate advancements in technology? And let me kind of talk about that. We talk a lot about broker efficiencies. You know, one of the topics that I hear a lot on Squawk Box and different people talking, again, Jamie Dimon talking a lot about this and saying, you know, banks, in order to remain competitive in the environment, They need to get better with their technology to create those efficiencies so things can move on quicker. What are you kind of seeing on your end? I'll start with you, Eric. I mean, your company is extraordinary with technology. UWM does a really fine job in terms of making brokers very efficient. And they certainly can limit a lot of their costs in terms of staffing with the efficiencies and the technologies. What do you kind of see happening in any advancements in the future?
Always. And that's one of the exciting things too, about going to trade shows, new vendors, whether it be, hey, improved loan operating systems or client relationship management systems, the CRMs, so in the front end efficiencies to make sure that, you get automatic alerts to you or your borrower or both if their rates drop by a half point, or if, the home equity or the home value estimators find that you might have enough equity now to drop PMI. So if you can have technology serve up these leads to you right away, make it very easy to refinance clients. That's definitely one thing. During the process, one of the things we love to do for broker efficiencies is have it take less time than it used to. When I wrote loans, you were stacking a paper file in order. Now, there's digital applications. You have dockless income verification. We just rolled out a new dockless through Equifax where it's $50 or so. You pay a fee. We go back at day one certainty by pulling out pay stubs and verifying the income up front. So just a lot easier for clients to think it's fewer touches, a lot less time for a loan officer and processor. So maybe I'm able during margin compression to make a little bit less money per loan because, let's just face it, I'm not spending 5 hours and trying to get a loan to the finish line. And then the back end, just making it very easy to retain clients who like continuous touches.
Yeah, before I kind of lean on to John, I know that there's a lot of people out there that really do use United Wholesale a tremendous amount. And I see a lot of posts on Facebook about, hey, this loan got cleared to close in 5 days, 8 days, 9 days. And I think a lot of that is a testament to the landscape and just kind of we're not going to go back to question one. But we talk about how does an originator kind of remain relevant in this marketplace. I see the emerging mortgage broker having, a high level of excellence by being able to utilize some of those tools and creating the more efficient standpoint, because that can help them in that pre-approval process and stand out for the masses. So, bravo to your team, what you've done out there, Eric. John, we'll bounce over to you. Any thoughts on technology?
Yeah, we're always, I think that's where non-QM can do, and we're doing that, but a lot better job bringing technology to the broker there. We're continuing to tweak an automated underwriting system for non-QM. We in fact, right before I got on this call, we had a call internally on, how our bank statement review process is and the AI that's in that process, just providing a return to the broker within, an hour or 5 minutes, depending upon the bank statement. So continuing to evolve in that space. We continue to update our quick quote tool that we have on our site where people can go in and just put in, 5 to 10 pieces of information and get back rate quotes right there, just based on that high level information. So I think, again, continuing to make that experience for the broker, which in turn for their borrower, that experience a lot better. And, the quicker you can close a loan, the quicker that broker gets paid and that borrower gets in that house.
Yeah, we look at, and I'm going to jump in AI here for just a moment before we go on to the next question. But, it's interesting. We live in a rather unique world, and the world we live in is, you talk about that loan originator that's in the street. I kind of look at the guy with the octopus with the 8 hands, because you got to manage your emails, you got to manage your phones, you got to manage social media, you got to manage text messages, you got to even manage WhatsApp now. So it seems like that information technology, the communication becomes so crucial. So that's really a good point. Again, a great strength for the emerging mortgage broker that doesn't have some of the regulatory concerns that banks might have. Let me jump into AI for a moment. That is obviously a huge topic these days. Does UWM have any thoughts or strategies with regards to AI? Anything that you're seeing out there with regards to AI? What are you hearing about that?
So one of the products we rolled out last year at AIM was Bolt. It's using AI to scan your documents and give you an instant approval up front before an underwriter has to look at it. So we're definitely been looking at that. I'm not too familiar with AI myself. I have a teenager who probably can talk circles around me and tell you about it. The one thing I will say though is I know like, for social media, kind of going back to what John said, getting comfortable being uncomfortable. If you're trying to get on social media and generate content, I know some people are saying, listen, AI, ChatGPT can help me kind of scrape for content and put things out there that, they might be getting hit. So that's kind of my extent of what I know about it.
Yeah, it's really kind of an interesting tool. I'm kind of dabbling with myself as well too. John, what are your thoughts about AI?
Yeah, we're continuing, like I said, just got off a call with our bank statement team and continuing to evolve that in the process, along with it, continuing to tweak the automated underwriting systems. I kind of coined the term last month, about AI, but, you know, Angel Oak has RI, real intelligence, with our account executives. And,
Right.
and those are, you know, seasoned AEs in the street that have seen every outside the box scenario. So I've been using RI, and kind of go back to the first question, is, you know, our portal has available all these different flyers, you know, posts, social media posts, you know, realtor presentations, you know, because it's all about education, right? It's about educating the borrower. It's about educating brokers. It's about educating your referral source. And I know we do with RI, we do a great job educating everyone in the industry out there and what's available to them to help them grow their business.
Thank you. Those are great comments. I appreciate it. We'll bounce on to question number 5. So I'm really going to kind of lean, John, on you on this one, because, you know, you and I have had some conversations in the past about kind of the regulatory environment. Again, Jamie Dimon just coming out and saying, hey, we got to really control, you know, we really have to control regulatory, you know, documentation, so on and so forth, all of that. And we hear a lot of fear about credit tightening. You know, what will the regulatory environment look like in the future? I mean, do you see kind of more of an opening, a more flexible, because you have all of these technological tools, right? Things at your disposal, as Eric mentioned, you know, just higher levels of efficiency to get certain things done with review of documentation and pulling through technology to get documentation. John, you talk about streamlining the bank statement process. You know, where do you see kind of the regulatory environment going here as we move towards the future, and certainly in an election year?
Yeah, you know, what I can speak to is more about ATR, right? The ability to repay. And you mentioned it a little earlier, you know, you mentioned the dirty word subprime, but, you know, it's still the ability to repay, right? So, and we abide by that. And, you know, that's the biggest thing we do from a regulatory standpoint, is just make sure that borrower qualifies and we meet all the CFPB regulations on that standpoint. But I'll go back to what I mentioned earlier. I think a lot of it's going to come back to, does the government want to be in second homes and investment properties going forward? That's really, and maybe selfishly, you know, I look for that business to come to the private money sector, which would be non-QM, non-agency.
Yeah, it's an interesting point as you talk about, you know, they're kind of in a conundrum. You know, from one perspective, they're talking about creating an affordable housing environment. So they sort of penalize to a certain degree, you know, the investor and the second home borrower. But then from the same perspective, you know, you look at the younger population, the consumer that's out there, right? Post millennials and millennials are now rampant. They're in the marketplace. We see a significant improvement, you know, here in the Latino market, as far as, you know, being able to acquire more housing. And we just see that more people are thinking homes long-term for me are a true investment. I think that both of us have been in the business, all three of us, for a very long time. We know that, you know, an American here in the United States, as a capitalist, typically for us, people in the United States, their greatest asset is going to be their home. So certainly reaching more into the second home and investment market seems to be kind of where we really need to go.
Yeah, and I also see on that, and like kind of, you know, what I look at it too, in terms of regulatory environment, is it seems like there's, you know, the hot topic that originators feel, but I think the government federally and even states see this as the housing shortage and affordability, right? So in Florida, you know, the Hometown Heroes option, which, you know, they just expanded to be in an even larger grant. I think knowing that these are some of the challenges we face, and knowing that we want to, you know, get more home ownership, that will impact housing by making, you know, again, some of these programs more affordable for the first-time home buyers. You know, they tweak the LLPAs here and there to make it a little bit easier if you have a lower down payment. So I think those things will make an impact as well moving forward, knowing that they're going to try to do something to get more people into homes and make them more affordable, because it hasn't happened. You know, home prices maybe took a little slowdown for a while, and now they're coming back up again, depending on the area. So I'm hoping that's going to make more options available to the people that are still here writing loans.
Yeah, thank you. Those are two great comments. Thank you. Eric, I'm going to lean on you for a moment. You've been in the business for a very long time, many, many years. You've seen a lot of the highs and lows in terms of rates and so many other things. You know, what recommendation or advice would you give for newer loan officers, people that may have started their careers in the last 5 years, maybe less than 5 years, but we have a lot of new loan officers that are entering the marketplace? Kind of an interesting statistic. You know, we've seen here, I don't know what the most recent numbers were. When we go back to February, the Office of Financial Regulation was kind of sharing with us that, you know, when you're looking at sort of the mortgage banker landscape, we've seen a lot of licensure come down off of that, which means that people more out of state might not be renewing their license, but we've seen a significant significant increase in the state of Florida with mortgage brokers and the businesses for mortgage brokers. So kind of a big uptick there, a big shift. So if you're kind of new to the industry, any recommendations you have on your end?
A couple of things I would say is one, if you're in the last 5 years, let's just say you started 5 years ago, you've seen the highs and lows, right? We had some of the biggest years ever, but if it's sometime even shorter, for anybody, I would think always make sure you know your resources and you use them. One thing I think that I'm very good at is asking for help when I need it. And so if you're a newer LO, there's a whole community of people either on social media, at these trade shows, locally, that would be more than happy to help you with some of the things that they've done. And then on top of that, just the resources out there with technology, with some of the trainings we do. I know here UWM, we'll bring you out to train you, but just take advantage of everything you can to build your knowledge. Because if things are slower right now, embrace that part of the cycle. This gives you more time to build relationships, go after network, go after the 50 people in your life that could be good referral sources where they'll think you as a go-to, so that when things pick back up, you've already set that. And then the last thing I'd probably say is, have structure. I think, this is a very complex business, and being in this, we've all been in a long time. It's evolved a lot, but, even with technology, it's still be very complicated. And that real intelligence John talked about is important, but, are you making sure that you have structure? Because with things being so complex, structure kind of creates this level of comfort for you, and it develops a process so that when something goes wrong, with the borrower or with important realtor source, you're able to make sure you handle that because you have a process in place, and then continue again back to that repeat business. We think that's the name of the game right now. Regardless of the market, if you're able to capture that business and stay in front of them, that's how you're going to develop a lasting business.
Thank you. Those are all really great comments. John, anything you want to add to that as far as if you're kind of a new to the game, any thoughts on how you would recommend somebody getting jump started now?
Yeah, but I'll go back to one other thing. You talk about affordability in an underserved market. I think that's one of the things we do really well with that self-employed borrower, right? We increase their purchasing power so we can make, those homes affordable for them. So just wanted to touch on that. And, I'll go back to a lot what Eric said, create structure. Mentor. One of the things FAMP does a really, really great job at is mentorship, right? That's what we've been doing for the last, well, you guys have been doing it for a long time, but you embraced me and brought me into that loop for the last, 3 or 4 months. So, grab someone to be either be your mentor for someone or ask someone to be your mentor. There's no better compliment than going to someone and say, hey, would you be my mentor? Help me. But I think when it comes back to real hard work, putting the time in, as Eric mentioned, there's a little bit of downtime right now. Learn everything you can.
Yeah.
Get with your account executive. Your account executive can teach you the ins and outs of whether it's the agency business or the non-QM space. I think that those are key things. And I'll go back to time block. I mean, I would challenge everyone on this call to go look at your calendar, plan your calendar for next week, and put that structure in your week.
Yeah, and Eric, you mentioned your group does an outstanding job, bringing brokers up to create some community, create some, education, and help them with that structure. So that's always a great model. I think the both of you gentlemen have done a great job. Both of your organizations have always been present with your account executives, and I love that RI piece you talk about, John. Is that the best value that anybody who's new to the business can really kind of feed off of our events that UWM puts up when people are going out and getting like hands-on training, as well as your account executives. So all really good points. So thank you for that. I'm going to go ahead and open up to any questions that might be out there. Let me see. I think there might be one question out there.
There is,
so,
yes, there is one in the chat box. You want me to read it to you?
yes, if you don't mind, please.
Okay, absolutely. Actually,
Thank you.
might have just another one here. Hang on one second. I just got to scroll.
Yeah, if you have any questions, please throw them out there. And again, I appreciate both of you gentlemen so much for taking some time. Great information, by the way, really packed full of nuts.
Absolutely great content here today. So here's the first question. I know UWM has rolled out the 1% down program. Angel Oak is always adjusting and staying competitive. Can you share any additional creative programs in the works?
All I know is we kind of don't roll out new programs. We just continue to enhance our programs. And, I would just say, if you're not signed up for our weekly email, I would sign up for that. That we're always showing new enhancements in that. Again, rely on that RI, that real intelligence with that account executive. And then, one of the things we've been doing now for 2.5 years, and it was right after COVID, we do a monthly webinar. And we do deep product dives into bank statements. We've got one, I'll do a shameless plug, next Thursday at noon Central Time. We're doing a deep product dive into, I believe it's bank statements. So, that's one of the things we do. We just similar to what you guys, LOs can ask deep product dive questions, and we have 2 subject matter experts who are on that call to answer all those questions. And if we don't get to them, because there's a lot of questions that come in, their account executive reaches out to them right after that call. So that's kind of what we do. We continue to educate this space.
Thank you, Eric. Any comments from you?
So they're not so much in the works, but something we've rolled out pretty recently, which kind of tacks on to the housing shortage, one-touch closing. So VA and conventional, we now have a construction program for wholesale. And it's big because, I think one of the misconceptions is a lot of the builders out there have in-house lenders, which is not true. I think the majority of them are smaller. And some of the data shows that probably over half of the builders out there don't have somebody set to use. So having a product like that, I think it's a great time for builders with a housing shortage, because they feel I can keep building forever now and there'll be somebody to buy it. So I think that probably was one of the hotter topics or hotter the programs we rolled out that we get a lot of questions. So I would look at that one. And then jumbo, I don't think in Florida, there's a lot of high balance counties where you can go up to 726,000. So, one of the things we try to go after is how can we make our jumbo product more competitive? And if we can't beat the banks all the time, what is the most aggressive price we can put out there? So we have 6 different jumbo products for each of our 6 different investors. Some of them are easier, like you can run it through AUS. So I think that's one of the things, as home prices go up, depending on your market, I think jumbo is a nice one to tackle. And, some people just don't want to go to the banks, or sometimes banks don't give the great service. That's an area where brokers can fill in and take care of some jumbo clients and get into those markets.
Yeah, it's a really great point you bring up with jumbo, because you are correct. When you look at the landscape out there, jumbo has typically been captured by naturally your FDIC group, and in many cases right now with the shortage of housing and some of the tightness of the market that we're seeing out there, and speed, which is so incredibly crucial, you may have to leave a little bit of money on the table. Being able to offer a more competitive as possible product in the jumbo landscape certainly helps a lot of mortgage brokers be more competitive when competing against banks for that. So good point. Thank you. Question number 2, Linda.
Sure, absolutely. Similar to the new LO situation, after my wife received a significant promotion, I recently moved my business from the West Coast to Florida to the West, from the East Coast of Florida, to the West. With a pharma sales background, I have always focused on calling on realtors for referrals. Since COVID, more realtors are working from home. What tips do you have to establish new relationship and differentiate yourself when realtors are receiving a lot of calls during the day from other LOs? Did I spit that out properly?
Yeah, no. And
I mean,
feel like
basically, in short, what do you do when realtors, you can't get to them because they're just at home? So, and
Right,
there's strategies
exactly.
you can think of.
So social media, right? So everyone's on social media. I look at other people to market yourself to, again, self-promoting here, CPAs, right? Who does their taxes for self-employed borrowers. They write off every day on their tax returns, therefore maybe use their bank statements. There's all different, we have an AE out in the West Coast who says, how do you find a self-employed borrower? Open your front door, you will trip over them, right? So any strip mall you're going into, dry cleaning off, or a restaurant that wait staff, they're all, for the most part, self-employed. Stop chasing the same people that everyone else is chasing. Look to market yourself outside those normal channels. That's what I would look to do. And that's something else we do for you. And that's something else we do on our monthly webinars, is how do you market yourself to those different channels?
That's great advice. I would add on it, because that was one of the challenges I faced coming over, working from Quicken for 4 years, buying, getting leads fed to me, then going to work for wholesale, trying to self-gen. And back then it was kind of you walk in a realtor's office and then they're all there and you have like a presentation. That went away. So, but on the flip side of that is there's, they are at home. There's more technology than ever to reach out to them. And one example is you can buy data. So if you go to something like MMI, you can kind of get a target down which realtors do you want to approach that maybe are working with, certain only like retail lenders where, as a broker, you have more competitive pricing or you can close things quicker. So getting in front of them electronically yeah, it's a little harder, but at the same time, you're not driving around from office to office hoping you catch somebody at the right time. You know they're going to be home. Everybody's tuned in all the time. I mean, think of how many times do we all check our phones for emails throughout the day, right? It's constant. So if you're able to have a value add to these realtors, again, embracing the fact that, listen, I'm not going to be in your office, but maybe we can set up a coffee. You know, one of the easiest plays that I've seen run to get in front of realtors that, you know, aren't physically in an office is you look for the listings that they have. And we have something on our website called the Home Value Estimator, which is a very detailed 9-page report on the property and all the comps. And we have loan officers that as soon as they see a listing, they will email that over to a realtor, you know, and this might cost a realtor quite a bit of money, but I'm going to serve it up to you. Every time you have a listing, give me your properties. And that's my foot in the door. So really just getting, like, you know, going back to John, if you're not comfortable with like using social media, getting on technology, buying data to kind of target it out, and then trying to set up a face-to-face call, then I would start doing that. And then the social media thing, like John said, I mean, I remember back in the day, people said, why would I ever go on Facebook for business? That's for, you know, married people or whatever, kids. And then look now then they're saying, well, why would I ever go on TikTok or Instagram? That's for young kids. And then inevitably everybody's on there. So it's just one of those things, find where they are. I think realtors are getting savvy to that too, that they want to get out there with social media, offer them something they don't have, like set them up with a videographer, give them content, and then, you know, then you go for that face-to-face appointment.
Yeah, those are great points. Also, you know, database management, you know, going back to your pipeline of people that you've closed loans for, making sure that you're remaining present and relevant. And I think that both of you have reiterated this over and over again. And certainly, you know, your organizations provide a tremendous amount of information and content for education. But I think now we kind of have to shift the focus a little bit more direct to consumer. And it really does come down to education. So great points. Thank you. Was there another question that popped up there, Linda?
There's a comment. It says, I've used the home value estimator for open houses and the realtors do love it. I actually have a question for the panel. As far as is Florida one of your top 2 states as far as production within your company? And if so, or what, that's one part of the question. And then the second part of the question is, what is the product that you have the most percentage of, as far as on a kind of monthly and annual basis? What's your hottest product that you do a large amount of business of?
Yeah, definitely Florida is top 2. And our number 1 product is bank statements, you know, and it's probably double the next closest product.
Yeah, I'd say for us, you know, Florida is definitely, I definitely top 5. I'm not sure if it's 3, you know, because we do quite a bit in California and Texas, but definitely one of our biggest markets for originations. You know, we're primarily conventional, so I think that's our bread and butter. I'd say 80% of it. You know, 90% of our business is purchase, 80% is conventional. You know, we do some non-QM, but I think Florida is very, for me as an originator down there, I do see a higher percentage of all the government products too, which is very nice, right? In some states, it's a lot of conventional, but there's so much opportunity for USDA, FHA, and VA, obviously. And I see those increasing. You know, I think when I was an originator or AE here, you know, I'd say maybe 1 out of 10 of my loans was FHA. Now, you know, it's Florida, especially 1 out of 4, 1 out of 5.
Thank you.
Linda,
That's very helpful.
Back to that question, you know, you talk about a percentage of the workforce that continues to grow. I'll go back to, you know, new business applications and how they grew in 2020 by over 24% over 2019. That was the largest increase in new business applications in this country in over 10 years. And in 2021, how that grew by 22% over 2020. So you have there are more self-employed borrowers than there are VA borrowers. And I think once you could get comfortable, and everyone thinks, you know, non-QM, you know, brokering a loan is an uncomfortable experience. It's not. You know, Eric mentioned, you know, we have loans that close from submission to closing. You see a lot of our AEs post that out there. They've closed in 12, 10, 14 days. So it again goes back to the, you know, get comfortable being uncomfortable.
Mm-hmm. Yeah, great points. Thank you. I don't think there are any other questions at this time. So, you know, gentlemen, we just can't thank you enough again for your extraordinary partnership here at the FAMP. Again, as Bees Knees title sponsors, we talked about what that was. Your continued support of the emerging mortgage broker and the comments you made today are just invaluable. So thank you for just being terrific partners and of course, supporting so much in this industry.
Thank you. And thanks to FAMP for having us.
Yeah, thank you. Appreciate it. Eric, it's a pleasure meeting you.
John, thank you very much. I learned a lot.
Eric and John, thanks so much. We'll wrap up with you.
Yeah.
Thank you to all our members out there, and we appreciate you. We'll see. Well, I assume I know, John, we'll see you at the convention and trade show. Eric, will we have a chance to see you down at that time too, or will there be a different representative coming down from United Wholesale?
Different one this time, and I'm looking forward to getting down there.
Okay, well, we'll be
Great.
looking forward to seeing you when you do get down here. So thank you so much, gentlemen.
Thanks, guys. Look forward to seeing you.
Thank you.